Welcome to the debate. Today we are diving into the intellectual battlefield that is gold trading. This asset, XAUSD, is legendary, not just for its volatility, but for a systemic problem that really cripples most conventional strategies. The phenomenon of the institutional false breakout and the deliberate liquidity grab. The data is just unforgiving, relying on standard breakout tactics in gold gives you a win rate often below 40%.
Yeah, and that inefficiency isn't an accident. It's a design feature, really. Gold is practically engineered to exploit the predictable behavior of retail traders, trapping them at the most obvious points of market structure.
Exactly. And that systemic failure brings us to our central question today. When you're confronting gold's relentless volatility, should traders rely entirely on a comprehensive, quantitative, engineered system, what we're calling the Magga 1 protocol, driven purely by statistical proof and algorithmic consistency, or does superior performance absolutely demand the flexible human interpretation of price action and the crucial market context that, inherently bypasses any rigid rule set?
I come at it from a different angle. While I agree discipline is essential, I believe a total reliance on inflexible quantitative indicators and algorithms, it just inevitably overlooks the essential language of the market, which is structure and context.
Well, I'm going to argue for the absolute necessity of the Magga 1 protocol. My position is that we must replace human emotion and inevitable cognitive bias with systematic mathematical logic. It is, I believe, the only reliable path to long-term success and an asset that is specifically designed to hunt your stops. We're looking for reproducible science over subjective art.
And I'll be arguing that focusing purely on statistical measurement creates critical blind spots. Genuine, high-quality momentum is still best interpreted through universally recognized price structure and contextual clarity. If you ignore the market's actual terrain, you're just walking into a trap no matter how elegant your mathematical map is.
All right, so let me start by detailing the systematic solution that Magga 1 proposes to fix that low win rate. Conventional entry relies on breaking arbitrary prior highs or lows, which, as we've said, is exactly where institutional players orchestrate those liquidity grabs. Magga 1 implements a paradigm shift from reactive trading to a fully engineered system. It's built on 4 interlocking modules: entry, secure, defend, and profit. The core philosophy here is a statistical confirmation. We only act when the math is practically screaming at us. For entry, we call it the gate. It demands that price shows a force that exceeds the normal distribution, specifically by closing outside the calculated daily volatility range. That's the SD pivot plus 1 standard deviation. This entry is a mathematical recognition of market panic. It's the threshold where price movement exceeds what the 90% of normal distribution would allow, signaling true institutional urgency, not just some casual market fake-out.
That's an interesting point, though I would frame it very differently. I do recognize the immense intellectual rigor required to build a framework like Magga 1. I mean, it's an impressive attempt to systematize chaos. However, my concern is that the rigor is potentially misapplied if it's focused on the wrong inputs. You're successfully creating an entry trigger that identifies what happened, a statistically significant price explosion, but it can't discern the structural why or the contextual authenticity of that move. The market, you see, it speaks through context, not just formulas. Is this movement genuine, high-volume institutional flow, or is it a low-volume spike engineered just to catch stops before the real players even show up? Focusing only on statistical force over universally recognized price structure, like a confirmed swing low, and crucial clues like market session volume, well, that creates glaring vulnerabilities. A truly robust system requires human intellectual input to validate that context.
I hear your emphasis on context, but the SD pivot is specifically designed to isolate movement driven by a force that objectively exceeds normal parameters. It's meant to filter out that low momentum noise. We're replacing arbitrary lines drawn on a chart with a direct measurement of market energy. If gold's average true range is, say, $20, and suddenly prices move $30 and closed outside that band, That is objective, unbiased proof of exceptional force. The system must capture that opportunity instantly, and the SD pivot criteria is mathematically superior to simple arbitrary high-low breaks, which, as we already established, are often just a bait.
The force of the movement is undeniable, I'll grant you that. But it still begs the question of authenticity. How can you confidently talk about exceptional force without considering the engine, the volume, and the time that produced it? I'm just not convinced that the SD pivot is complete without some kind of time filter. Let's talk about the when. A volatility break that happens during the low-volume Asia session, a period that's notorious for deceptive spikes. It often lacks genuine follow-through. It is a classic head fake.
So you're suggesting we should just ignore statistically significant force simply because it occurred at 3 a.m.?
I am suggesting we understand the quality of that force. Conversely, a break of that exact same statistical threshold during the high-volume London or New York overlap is backed by massive liquidity. It reflects genuine institutional participation and market drive. By ignoring the context of when the movement occurs, the system risks walking directly into institutional traps. You are prioritizing the mathematical magnitude over the quality of the participants who are actually involved.
But implementing a rigid session filter, let's say only trading London or New York, it risks missing entirely legitimate, high-impact opportunities that arise from unexpected news or geopolitical events outside those specific arbitrary hours. We are betting on the cannon blast, regardless of whether it was fired at noon or midnight. If the market moves with that kind of genuine objective velocity that exceeds the statistical norm, that's our cue, not the ticking clock. We prioritize consistency and capitalizing on objective force over the calendar. We accept that trade-off.
But that trade-off exposes a fundamental flaw in the logic. You're assuming all volume is created equal, which it demonstrably is not. The highest probability movements occur when the dominant market participants are active. End of story.
All right, if we can't agree on when to enter, let's talk about protecting our capital. Because I suspect your rigid price action rules fail when it comes to risk management too. We defend using the ATR stop loss, specifically ATR multiplied by 2, as the most reasonable solution. It's dynamic. It adapts automatically to the market's current volatility, providing that necessary breathing room to prevent premature exits due to just random short-term noise. Fixed dollar stop losses are simply irrational in a volatile asset like gold, because the acceptable volatility floor changes every single day. ATR manages risk adaptively based on current market physics.
That's a compelling argument on adaptability. I'll give you that. But you are creating an internal metric that exists only on your spreadsheet. The market does not care about your private ATR calculations. The market respects price structure, not our math. The market is a battlefield. And structure, that prior swing low, is the visible fortress. Institutional players target whatever is exposed and undefended. When a stop loss is placed below a confirmed prior swing low, you are positioning your risk behind a recognized strong wall that global participants, including institutions, can see and respect. It is a visible structural barrier.
And how do you objectively define which prior swing low is strong enough to respect and which one is just historical noise?
Well, the definition is visual. It's based on the depth of the pullback, the reaction speed, and the volume that supported the reversal. That is the very essence of market logic. Your ATR calculated stop loss, in stark contrast, just floats in technically insignificant areas. It lacks any structural protection, making it easy prey for price spikes that are designed specifically to clear out liquidity from those non-structural placements. We're choosing to defend via market logic, placing stops behind recognizable structural cover versus defending via private mathematics that the rest of the market completely ignores.
But the precise problem with the swing low is that determining which prior low is significant is inherently subjective. It's prone to human interpretation error. ATR removes that bias entirely. Risk becomes purely a function of current market physics, its energy state. We are choosing adaptive protection based on current activity over rigid structure that may just be a historical relic. The source material itself refers to this as managing risk adaptively, letting current volatility define our risk, not some fixed historical point on a chart.
But the market is the collective memory of buying and selling pressure, and that memory manifests as visible structure. Ignoring that shared memory in favor of a short-term volatility calculation is fundamentally short-sighted. Your ATR stop might be adaptive, sure, but if it's sitting right in the middle of a vacuum, it's still getting taken out by a minor institutional sweep. You are adapting to risk, but you are failing to hide from it.
Let's move to profit-taking. This is arguably where systematic trading truly shines, eliminating the human psychological flaws of greed and hope. We call our exit module the sniper. We defend using the ADX index, specifically waiting for the indicator to go above 45 and then hook downwards, as the sharpest way to exit precisely at the peak momentum point. The trend is exhausted. The debate here boils down to immediate closure versus trying to maximize the runner. We use ADX to capture the peak momentum, while you advocate waiting for visual price action confirmation, a decision that inevitably forces you to give back profit.
That's the critical trade-off, isn't it? And I'm just not convinced by that line of reasoning, because this mechanical approach severely risks selling the big winner. Prioritizing the ADX hook down is like driving a race car and slowing down the moment you feel the slightest shudder, afraid you might lose a second. Sometimes that shudder is just the car shifting into the next gear. In a strong, genuine, bold trend, the market may simply be consolidating its power. That causes a temporary dip in the ADX reading, which, crucially, measures the rate of acceleration, not the reversal itself.
But the reversal usually follows the drop in the rate of acceleration.
Yes, but if the system exits purely based on that one indicator dip, while ignoring confirming price action like a tight consolidation or solid green closing candles, it's like getting off the train many stops before the final station. You potentially miss huge continuation moves that follow a mere consolidation. Price action interpretation allows a skilled trader to distinguish a temporary dip, which is consolidation, from true exhaustion, which is a structural breakdown. The indicator tells you momentum is slowing, but price action tells you whether the buyers have truly abandoned the asset.
But waiting for price action confirmation inherently means surrendering profit because price action signals lag. The system prioritizes consistency and the capture of the largest, most statistically reliable portion of the move. We choose to sacrifice the final, unpredictable profit dollars, which are often lost to the market anyway, in exchange for the systematic, fail-safe capture of the majority of the move. The ADX peak exit focuses on the highest probability moment to close, accepting that the last 5% of a trend is often the most dangerous and unreliable.
The counterargument, though, is that by being overly quick to exit, you are structurally limiting your winners. You're preventing the fat tail events that often define a successful trading year. The ability to hold on to a true runner, supported by confirming price action, is the hallmark of effective trading. Your system may protect against the risk of giving back profit, but it does so at the cost of capping true opportunity.
And that brings us right back to the heart of the disagreement. Do we trust the subjective, lagging, and emotionally prone interpretation of human observation, even skilled observation, or do we trust the cold, hard logic of data and systematic process?
Well, for my part, I must reiterate that while quantitative tools like the SD pivot, ATR, and ADX are immensely powerful for analysis and for enforcing discipline, they absolutely must be combined with human judgment that understands the market's context, its structure, and its unique language, which is price action. An overly rigid system, even one as sophisticated as Magga 1, is vulnerable to the nuances and the edge cases that indicators by their very definition cannot capture alone. Relying only on statistical triggers and internal calculations leaves us blind to the structural integrity and the contextual validity of the moves themselves.
And I'll conclude by reiterating the core, non-negotiable benefit of the quant approach: consistency and the elimination of human failure. Fear, bias, and greed are the greatest destroyers of capital in highly leveraged, volatile assets like gold. Systematic, rules-based on objective statistical significance, be it the entry at the SD pivot, the defense via ATR, or the exit via ADX peak, are not just preferable. I'd say they are necessary for survival. This approach changes trading from an unpredictable art reliant on talent into a reproducible science, where clear, data-driven rules maximize long-term, non-emotional opportunity.
We have certainly illuminated the complexity of this strategic dilemma, whether to trust the mathematics of the machine or the structural logic of the market.
Indeed. The source material itself, with its focus on ongoing research into validation, timing, and the optimal placement of risk, it really underscores that this tension between systematic rules and necessary contextual interpretation remains a vital, unresolved area of exploration for all serious traders.
It is a profound complexity, leaving the serious trader to weigh the ultimate value of rigid discipline and objective measurement against the invaluable insight offered by understanding the market's structural language. Thank you for this rigorous discussion.